again, this is Amanda Fliskowski with Protective Life. Today we're going to be talking about a product called a Custom Choice Universal Life product. Now, don't be alarmed. We are calling this an alternative to term. Okay, Protective. Remember me saying Protective has a product that's unlike anything else in the industry. And I'll give you a little background on this product. Just a moment, guys. I'll give you a little background on this product because it's, again, very, very unique. So when you see Custom Choice Universal Life, you traditionally think that, hey, that's a permanent life insurance product. But with Protective, this particular product is not. And a little bit of background on where this product started was you have to think about a traditional term life insurance product. Traditional term policies, whether it's a 10, 15, 20, 30-year policy, what happens at the end of that 10, 20, or 30 years? Well, the prices skyrocket. Traditionally, those premiums jump up 2,000, 3,000% after that term period. After that level term for 20 years, in year 21, those prices skyrocket. Well, Protective used to have just a term like all the other life insurance carriers out there. And I tell you what, we received so many phone calls. We received so many phone calls in our service department, and it was individuals, clients, that were at the very tail end of their term period. So they were right at the end of that 20 years or that 15 years, and they saw that letter that indicated where their premium was going to go. And so, you know, after the hemming and hawing back and forth, and we let them vent a little bit, the funny thing was at the end of each of those conversations, more often than not, what happened was those clients said, hey, you know, I hate the fact that my premium's jumping from $50 a month to $450 a month. I can't afford that. So what can I get for the $50 a month that I am paying now? And that truly was essentially the genesis or the birth of Protective's Custom Choice UL, because what we've done is we have created on a universal life chassis, a product that looks and breathes and smells and tastes like a term. So that means that it is designed really for kind of a temporary need, right, like a term, and it's priced like a term. But at the end of that term period, at the end of that 10, 15, 20 years, what happens is the price stays the same and the death benefit begins to decrease a little bit. So as you can see on our agenda here today, I wanted to share with you a little bit of the birth of where this product came from. We're then going to roll into a few of the product details and those sales ideas that I promised. And again, we are going to open up for questions at the end. So if you have a question, please do go ahead and write that down or save it till the very end. So that being said, talk to you a little bit about the birth of where Protective came from. Now we're going to go into the product details. So a few things that really set this apart from other traditional term products out there. The nice thing is, and I hit on it a little bit, is the coverage can be extended at no additional cost. So those premiums are going to stay the same. Again, if you look at this chart here, you see that blue line going across. The annual premium is going to stay the same. So that gentleman that was paying $50 a month is going to continue to pay $50 a month after his initial term period. What's going to happen is the death benefit's going to decrease, and then it's going to decrease a little bit every year until it bottoms out at $10,000. At that point in time, it bottoms out at $10,000, and that's where the price then starts to go up. Traditionally, guys, that happens between age 90 and 100 is usually where that happens. But the nice thing is when you get the illustration, when you run the illustration, it shows you right there in black and white what those numbers are going to be and what that death benefit's going to go to, whether it's in year 11 or year 16 or year 21 or year 31. It's going to be very straightforward, so the client knows what they're getting themselves into. So that being said, this is a sales idea that I love to bring up. This is one of 4 sales ideas that I'm going to be sharing with you guys. I like to reference what we call boomerang children. Okay, so according to Pew Research Center, a survey found that among all adults aged 18 to 34, 24% of them have moved back in with their parents in recent years because of economic conditions, right? So many kids, especially college-age kids, right? They go off to college And oftentimes parents put life insurance in place because they think, oh man, I'm going to do a 20-year term because at the end of 20 years, oh, my kids really should be out of the home. They should be self-sufficient. They should be, out on their own, finished up with college, and I'm not going to need that life insurance anymore. Well, I'll tell you what, you can see the numbers don't lie. There's a good chunk of children that end up back at home, back staying with mom and dad, and kind of getting themselves geared up to, maybe move out, saving some money so that they can start out on their own. And I'll tell you, this case study here is just that. In this situation, you had a gentleman that's 42 years old. He's got a few young children. You can see this is exactly what a protective custom choice UL, that term on a UL chassis, looks like. So in this case, he's a 42-year-old. He has a few young children, but he thinks, you know what? In 15 years, my kids, for the most part, they should be out of the house. Well, if he had a traditional term and the kids ended up back at home, he's not really going to have many options, because traditionally, if kids are back under the roof and they're kind of a liability and something you want to take care of, God forbid something happens to this particular gentleman, he's not going to have any options, because his traditional term is going to jump up in premium, and because he won't be able to afford it, doesn't want to pay that sort of premium, he's going to cancel that policy. He's going to drop the coverage. It happens all the time when traditional term life insurance is written. This is an alternative that I want you guys to be aware of, because in this situation, this gentleman's paying $49 a month for $1 million of coverage. It's 15 years. You can see it takes him through age 57. He's paying, very cheap, $588 a year for that $1 million. Well, let's say his kids come back home, one or two of them comes back home, and he's thinking, you know what, I'd still like to have some coverage in case something happens to me, because I still have kids under my roof. You know what, he's get premium's going to stay the same. See how that stays the same? This was kind of on a 15-year chassis, so meant to duplicate a 15-year term. But the difference is the premium stays the same. It's $588 annually, right? $49 a month, and the death benefit drops to $443,000 and change. And then at 59, it drops down to 402, and then 362, and then 322. And again, it continues to go down, and it bottoms out at $10,000 traditionally between age 90 and 100. So that is sales idea number one. That's really just utilizing that natural decrease that Protective's Custom Choice UL has. So again, priced and designed to look, breathe, and smell like a term, but at the end, it's a little bit different because price stays the same with Protective's Custom Choice UL, death benefit decreases. So that being said, sales idea number two, and Rod, you were hitting on this earlier, but there's a decent market out there for mortgage protection. And traditionally, when we talk mortgage protection, we talk about, well, if someone has a 30-year home loan, or, we need to put a 30-year term life policy on them to cover the balance of the loan. God forbid something happens to them. They want to make sure their family's going to be taken care of, and their home's going to be paid off. So what you see here, I'm going to show you an alternative and why Protective offers a more customized solution for their clients. But in this case study here, sales idea number two, mortgage protection, you've got a gentleman that's 35 years old. Great health, he's preferred risk. He just bought a home. Just bought a $375,000 home. And you can see here that over the course of 30 years, this blue section here, that's what his home loan is. All right, starts out at $375,000, and it jumps down to $176,000 by year 20. In year 25, $97,000, and then in year 30, it's zero, right? If this gentleman doesn't refinance, he has paid off his home in 30 years. So the traditional sales idea is to sell someone $375,000 30-year term to cover that mortgage, to help the family with a 30-year term. The alternative, my sales idea number two for you guys today, is don't sell them a 30-year. What we're going to do is sell them Protective's Custom Choice UL and sell them a 20-year. Beef up that death benefit from $375,000 to $500,000 of death benefit. So beef up that death benefit to $500,000 and sell them a 20-year, because what's going to happen at the end of that 20 years, in years 21, 22, 23, 24, 25, is the death benefit's going to decrease. But the interesting thing is it's right in line with how that home loan is decreasing over time. So the beautiful thing here is you're still covering, the home loan, the whole purpose for the coverage. But God forbid something happens to this gentleman in the first 20 years. His family has more than that $375,000. You've put an extra $125,000 of death benefit in place for those first 20 years. And then, of course, it's going to decrease very much in line with the decrease in the home loan. And then at year 30, he doesn't owe anything left on his mortgage, but he still has the $60,000 death benefit there. So when this guy's 35, when he's 65 years old, he's got $60,000 that he's still paying a pretty low premium for. So some folks might say, well, now at least he has a final expense policy. He's got a smaller policy. He can still use that if he would like. And so that is sort of the logistics of how our alternative to term, our Custom Choice UL, works in a mortgage protection scenario. But the beautiful thing for the client, not only is it more customized, but there's actually a cost savings for them. A traditional term for 30 years at $375 costs them over the course of 30 years over $11,000, $11,846. That's one of the top lowest price term carriers for 30 years, $375,000. Protective's Custom Choice UL, that 20-year $500,000 that we were talking about, over the course of the same 30 years, the client pays in $10,173. So that's a significant savings for them. That's a 14% savings over the course of time. So not only is this a more customized solution for the client, but it's a cost savings as well. So that was sales idea number 2. I'm going to hit back onto some of the product details that are pretty unique to Protective's Custom Choice UL. So here's the thing: is one of the nice things is all of Protective's single life permanent products are available for conversion. So traditional term policies are convertible for the most part, okay? Some people ask, well, man, this is a Custom Choice universal life policy. Does that mean you can't convert it because it's already a universal life policy? No way. You can still convert this product, which is great. This is Protective's assortment of our conversion options, and it includes our GUL, our Advantage Choice UL, our Index Choice UL, that's our IUL. So it includes all of the latest and greatest products that Protective has. So still has conversion options. The way that the conversion options work for this product, guys, is you can convert in the first 20 years or age 70, whichever comes first, the first 20 years or age 70. And some people ask me, well, man, you can convert for the first 20 years even if you have a 10-year term or a 15-year term? The answer is yes. Get this, if you have a 10-year term, you still have a 20-year conversion period. So if you let that 10-year policy, if you let that death benefit naturally decrease in year 11, you can still convert that. You can't convert the death benefit that it started out at, but you can convert that decreased death benefit for those 20 years or by age 70. Third thing when it comes to product highlights, though, is you have the ability to customize the death benefit period. This is something also very unique that you can't really do with a traditional term. And when I say you can customize the death benefit period, I mean you can dial into the number of years that the client needs. Traditionally, with a regular term policy, you're stuck with 10, 15, 20, 25, 30 years of term periods. But with Protective's product, again, because our Custom Choice UL is on that universal life chassis, it allows us to dial it in. If you have a client that needs a 5-year term or a 7-year term or an 11-year term or a 22-year term, something that's a little different, we can do that. I'm going to show you, that leads me into our next sales idea here. To give you an idea of how that might be applied is, I've got a gentleman that has, well, he needs coverage, right? He needs $1 million of coverage, and he knows he wants the coverage because he's got kids and he wants, he has a few kids that are in college and he just wants to make sure that they are, taken care of. Well, in this situation, he needs the coverage. He's only really needs it for 10 years, but he's concerned because right now he's got a couple of kids that are in college and he has other bills, school bills that he has to pay, and he wants to, if he can, have a decreased premium on his life insurance until his kids are out of college. And so what we're doing, and this is how you would dial in the term years, is same thing applies if someone wanted a 5-year term. If someone wants a 5-year term, Protective can do that. What we're going to do is we're going to put it on our 10-year chassis, and you tell us you need 5 years. We're going to give the client a discount for those first 5 years. And if they want to keep it beyond, if they want to keep it in years 6, 7, 8, 9, and 10, they can, but the premium's going to go up. It's almost like paying catch-up premiums. So this is an example that you're looking at here. In this situation, a $1 million term on a gentleman that's 45 years old at Preferred costs $752 for a 10-year term. This is year 11 because in year 11, everything sort of corrects back, but $752 is what a 10-year term costs annually. In this situation, because this gentleman wants a lower life insurance premium in the first 5 years, or let's say he only wanted a 5-year term if that was the case, premiums are $623.71 annually. So same $1 million, but he's saving him about, $100 a year. Not too shabby. What's going to happen though is in the next 5 years, premiums are going to go up. So essentially he's paying catch-up premiums through the premiums that he was discounted on the front end. And then again, if he decides to keep the policy beyond year 10, because we designed this as on a 10-year chassis, in year 11, premiums go back to what the 10-year would have been, but the death benefit starts to decrease, right? At that point in time, if it was on a 10-year chassis in year 11, premium stays the same. It's going to be $752 for the remainder of the policy until it bottoms out at $10,000 death benefit. But the death benefit dropped from $1 million to $556,000. So saves him essentially, instead of buying, a 10-year term and paying $752, if he wanted discounted premiums in the first 5 years, he can only pay, if he wants, he can only pay $623, and then it, pays catch-up premiums on the latter half of the policy. Sometimes people might see this example and say, man, $100, that's, doesn't really matter. But I will tell you, I ran an illustration yesterday on a business case. This actually was an individual that was a business owner, and he just took out a business loan for $4 million. So keep this in mind if you're dealing with business owners, but they have business loans all the time, and often they need to have some sort of life insurance in place to protect everyone from that liability, if you will. I ran a $4 million, the guy had a 5-year business loan, so he needed a 5-year term. And traditionally, someone might say, or another agent even might say, hey, just get a 10-year term and then drop it when you don't need it. Well, 10-year term is going to cost $9,600 a year for this 52-year-old in standard health, right? So he can either pay $9,600 a year for his 10-year term, or the case I ran yesterday is if he only needed a 5-year, I got his premium down to $7,700 a year. I saved him essentially $2,000 a year by doing just what you see in front of you. In this case, he needed a 5-year. He didn't need a 10-year, and I was able to customize the solution. So keep that in mind, because if you guys are ever in a competitive situation and you're up against another agent that's showing them, a 10-year, but the need is only for, 3, 4, 5, 6, 8 years, you guys can come in with a better solution so the client's not having to overpay. So he's only paying, saving him $2,000 a year. So that was sales idea number 3. The last thing I want to share with you guys, something again very unique to Protective's Custom Choice UL, is because it's on a universal life chassis, it can accept a lump sum payment, a single payment, or a $1035. No other carrier that I know of can take $1035 or single premiums into a term policy. because ours is on a universal life chassis, we can single pay or take $1035 into essentially a term policy, into our custom choice UL. So this final sales idea is one that I absolutely love. And it really has to do with policy reviews. And I hope that you guys are running into opportunities where you're asking your clients about their current coverage, because so many times, people's existing life insurance policies, they don't fit their current needs. People's needs change. Not only do people's needs change, but products change. Life insurance carriers are constantly trying to improve their life insurance products. So if you're not asking your current client base about their existing life insurance policies, you're missing out. This is an example of a situation that stemmed from a policy review. In this case, you have a gentleman that's 50 years old, great health still. He has a current universal life permanent life plan, an $800,000 death benefit. There is $200,000 of cash in this policy. It's a universal life policy that develops some cash over time. He's had this for years. However, he has two main concerns. One, he wants to work until he's 70. He wants to work from 50 to 70. He's got 20 more years of working, and he is adamant that that $800,000 is not going to be enough death benefit. Not going to be enough death benefit. Not enough to replace his income, if you will, during his working years. So that's his concern number one. Concern number two is his existing policy has no living benefits, no chronic illness rider, no long-term care rider, nothing of that nature that is going to assist him and his family in taking care of expenses associated with chronic illness. God forbid he gets sick. So those are his two main concerns. So let me share with you what we did. I like to call this idea a split 1035. You're probably familiar that you can 1035 money or take money from an old policy, surrender it, and put that money into a new life insurance policy. In this case, Protective's taking the entire $200,000 and we are splitting it between a true permanent life insurance plan and Protective's custom choice UL. So if you take a look at this, on the right-hand side here, we took Protective's custom choice UL and we bought a 20-year, $2 million death benefit. We put a lump sum in there for $75,000. So we took $75,000 of the $200,000 and we bought a $2 million death benefit, 20-year, paid up, no more premiums for this gentleman. So now he has $2 million. We took the additional $125,000 that's in that $200,000 surrender value, and we bought Protective's IUL, our Index Universal Life product that we call it our Index Choice UL. It's permanent coverage. It's guaranteed through his mid-90s. Death benefit we bought was over $536,000. No more payments. We put that $125,000 in. It is paid up. And we tacked on Protective's Extend Care Rider. That's our chronic illness coverage. So that means now this guy has a pot of money. That $536,000 death benefit now becomes a pot of money in case he gets sick and needs to access those funds. If he's unable to do 2 out of his 6 activities of daily living, he can take up to $11,100 a month out of this pot of money, and Protective just cuts him a check. This is what we would call indemnity. It's an indemnity plan versus reimbursement. That means no receipts have to be collected. Protective literally just cuts the client a check. If he qualifies to go on claim, we cut him a check every single month. No ifs, ands, or buts. He can do whatever he wants with it. So in this situation, this guy was ecstatic. He went from an $800,000 universal life policy to over $2.5 million of life insurance coverage. So this is so super unique to Protective because of the fact that you could take a portion of those surrender dollars and you could put them into a term-like product, right? A term alternative with our custom choice UL. So you got that $2 million for 20 years. And technically, he could keep it beyond the 20 years, and he'd have to start making premium payments on this side of the transaction here, and his death benefit would drop down from $2 million and then continue to drop down. But if he wants to keep some additional coverage beyond that 20 years, he has the option. And that's really what this is all about, guys. It's about options, making sure that your clients have more options on the back end with Protective's Custom Choice UL than they would with a traditional term policy. So before I open it up to questions, really my ask for you guys is, if you're looking at term coverage for one of your clients, seriously consider Protective's Custom Choice UL. And don't forget about all the different ways that this product can be used to benefit your client. It is so flexible and so unique that you have to keep it in mind. So ask the brokerage or VBA, ask the brokerage for Protective's term on a UL chassis, our Custom Choice UL. Anytime you're looking for a term product, take a look at this. Pricing is pretty much darn near close to what a traditional term would cost. Your clients are just going to have much more flexibility on the back end. So that being said, I hope some of you have a few questions. If you want to, we're first going to attempt to see if anyone wants to raise their hand. And let me see here. I think we have one. Nope, we don't. Anyone have any questions?
Amanda, how do you raise your hand if they want?
There should be, let me see here. There should be a place next to your name where you can click on, it looks like a little hand. But what we'll do, just in case, prepare yourself. I'm going to try and unmute all of the lines here. So if you don't have a question, go ahead and just mute your phone. I am going to unmute all participants so that we give everyone an opportunity to ask questions. Let's see here. All right, I think I have to do it individually. Let me go through here. And again, you guys are going to begin to hear some background noise, but I want to give you an opportunity to ask questions if you have them. So if you are by chance, let's see here. And I did get a question, actually. Someone asked, and they asked if the slides and everything will be available. I am getting a link of the recording over to the folks at the brokerage. But it looks like most of the lines are unmuted now. So if you have a question, speak now or forever hold your peace. Anyone out there have any questions?
Good morning. Is there a minimum coverage, a minimum amount, and a maximum age?
Yeah, so minimum amount is $100,000 death benefit. Minimum face amount is $100,000 death benefit, and the minimum age is 18.
And the maximum age?
Maximum age is, ooh, that's a good question. I want to say that it is 7. So for a 10-year, I think it is age 75. I can double check for you.
Thank you. I'm still in, then I'm 70 right now.
You're still qualified.
Thank you. Appreciate it.
Any other questions that you might have? It does seem like there's a few lines that I'm unable to unmute. So if you by chance have a question and you're unable to speak up, please feel free to reach back out to the Brokerage Inc. They can answer any questions you might have, or they can put you in touch with me. But before we go, we'll open it up one more time for those of you that are successfully unmuted here today. Any additional questions? Right. Well then, go ahead.
Can they drop in any additional money? I think they can, because of being UL. They could drop in additional deposits.
So that's also a very good question. The question was, can they put in additional premiums in order to maybe push the death benefit out further or increase the death benefit? And in this product, because Protective was really designing it to look and breathe and smell and taste like a term, they took that ability away. So really the premiums that are allowed is just what that, you know, that initial premium is. The only way to extend the coverage out and keep that original death benefit, you know, if it was started out at $500,000 and it was a 20-year, the only way to sustain that $500,000 death benefit is to convert it. And then at that point in time, they have a true permanent product, and their premiums will obviously go up because that's been that $500,000 death benefit is sort of locked in for the course of the remaining policy. So.
Thank you.
Any other questions here? All right. Well, Rod, we had a great audience. There are several folks on this call here today, so we're going to go ahead and wrap up. I appreciate everyone's attendance. Again, be on the lookout for this link coming out of the Brokerage Inc. And if you guys have additional questions, they're a wonderful resource for you. Rod, do you have anything else you'd like to share?
No, just thank everybody for their time. Give us a call, 469-635-6000. We can answer any questions. One of the things that I would recommend everybody to do is you can go to our website. You can plug it in and run some of these quotes. You can play with it a little bit. That really gives you a very good understanding of where the product will fit into what you're trying to accomplish with your clients, and you can see the pricing. But Amanda, we want to thank you for your time very much, and we want everybody.
My pleasure. My pleasure. Everyone have a great rest of the day and a great rest of your week. See you next time.
Thank you.